First thing I'm going to do, I'm Adam, just in case some of you have not met me. I am based in London. It is a beautiful day. We've had no summer to speak of, so today having a really nice day is fantastic. And first thing I want to do is check that you can see me and that you can hear me. So sound should be good. That's my microphone, and it all looks good on my side. So you should be able to, and see my screen as well. You should be able to see the economic calendar for the week coming up. All right. Here we go. And don't be shy, by the way. Please don't be shy. Please ask questions as we go through. The more questions you ask, the more you get out of the sessions. All right. Now, usually I tend to run a little over. I apologize. So 35, maybe 40 minutes. We usually are about half an hour, but I tend to add a little bit extra in. Okay, I'm going to assume no one said anything, no one said hello, but I'm going to assume you can hear me and see me. So I'm just going to kick off. Okay, so first of all, looking at the economic calendar this week, just keep in mind that the UK on Monday will be a bank holiday. That's just what we call a national holiday. They tend to call them bank holidays. So that will be a holiday, but the US markets will still be open. So what does it mean? It means that the volume session will be lower than normal, and especially probably more for you guys than for other people. So the reason I say that is if we go ahead and have a look at the market and have a look at the hours, here we go. You'll see potentially that you will overlap with the UK, and therefore this period of your evening will be, your morning will probably be much more busy, but your evening will probably not be. Okay, so then having a look at this, we have got, let's have a look at this. On Tuesday, we've got the consumer confidence. I would expect some volatility around the US dollar, all right? So we want to watch for any significant deviations which could impact equities as well as dollars. Then we've got crude oil inventories, and that could potentially move dollar CAD potentially. On Thursday, we've got GDP for the US. That would be a relatively big one. Any deviation kind of from this, the forecast is 2.8. The forecast is 2.8. Any deviation from this could lead to some strong moves in the US dollar and set the tone for broader market sentiment. And then the initial jobless claims as well, forecasted at 232,000 over here. That was the previous, so forecasted at 234,000. This would give insights into the US labor market. Obviously, any significant changes could impact the Fed policy decisions. Then we've got Eurozone CPI. Inflation is expected at 2.3. I don't know why. Okay, I've got it at 2.2 here. And this a lower number would obviously weaken the euro as well. So imagine that you get a strong dollar, for example, or a weaker euro, or a weaker dollar, stronger euro. You would see a bigger move there over the week. Then you've got PCE, which is the Fed's preferred inflation measure, which, and I would watch those numbers closely, obviously, because they could influence the next move with regards to US interest rates. And so basically what else? I would say, look, expect some volatility around GDP and the core, so around the GDP data and the core PCE data. And just this we could find that moves the US dollar, which means that it moves the majors. So just be prepared for that. That being said, let's go ahead and have a look at the majors. So all I've got on my screen here, just straightforward price action and a 50 and 20. Simple. Doesn't matter, you can have simple or exponential. I've got simple, I just wanted to check which one I had. So 50 and a 20. So what can I comment on? So let's start off with the euro dollar. So what else can I say here? First of all, let's just clean up all the objects. What would I say here? If we just zoom out and have a look at this, I would say we're pretty much overextended when you look at previous really kind of big moves that we've had in sort of going back this year at any rate, maybe even last year. These are relatively big moves. I would say that kind of as a standalone move from there to there, it's bigger than this move from there to there. It's probably about this. No, I think it's actually bigger or the same as that. It's probably definitely bigger than that to that. So we've had a really big, let's call it an impulse move. Very big, but it's not even just that. It's the angle at which it has been going. It appears to me to be pretty much almost straight up, just almost straight up, which is a very, very big move. Often in cases like that, at some point in this area, I'm going to start again at some point in this area. I would expect a deeper correction to compensate for the big move up. So it is possible that at some point, and it may not be this week, but at some point in the next 2 to 3 weeks, we would see a bigger correction coming back down here, or at least back down here. So if we do manage to move up and then come back down, we would get a movement back to these areas. Excuse me, it's not unusual for a currency to have a 618 retracement. So in other words, where equities might pull back a little bit, we could see currencies pull back further. It's not unusual, they tend to do that, but just putting that on the table. So if we then have a look at sterling, so sterling is very aggressive. So sterling, if you look at this move, that one is much bigger. It's bigger than that, it's bigger than that. And at the angle here, so if you compare the angle here to the angle here, this is much steeper, much more aggressive. So at some point, again, some points, potentially this week or next week, I would be looking for a correction. So it's showing here, first of all, that the euro is strong, the pound is strong against the US dollar. Aussie dollar also almost straight up here, very aggressive, so that's a strong. So what are we seeing? Are we seeing a weaker US dollar? Okay, weaker US dollar, this is Kiwi dollar against US dollar. Now, if we're right, if it is a weaker US dollar, then when we switch it around and the dollar is in the front, then I would expect dollar yen to go down, dollar Swissy to go down, and dollar CAD to head lower. So let's go see if that is the case. So go across, if it's the dollar that's moving stuff, so dollar Swissy heading down, looking nice and bearish on that one. We've got dollar CAD is looking nice and bearish over there, and we've got dollar yen also heading lower. And let's just see what dollar Sing is doing. Dollar Sing is heading down. So to my mind, dollar Sing is actually the closest looking to the dollar index. So if you haven't heard of it, the dollar index, the dollar index is a basket, is the measurement of the performance of the US dollar against a basket of other currencies, which includes the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. Okay, and it was introduced, been around about 1973, which is more or less when the currency markets got going. Why do we have a dollar index per se, and not really a euro index or a Swiss franc index? Well, because the dollar is the biggest cog in the system. It's the biggest, it's used in 90% of the transactions on the planet. The US economy is the biggest in the world. And it is by far the biggest currency in the currency market. So you've got this US dollar, which is almost like 60% of the currency market. The next one is the euro, which is probably only about 50% of the remaining amount. And then it just gets smaller after that. Excuse me, but you can see how it's been dropping off here. Now, out of interest, let's go look at the actual dollar index. So over here, I can, is it this one? I can see the dollar index if I want to. So let me just save this. Let's go across and have a look at the DX. And then let's have a look at this from a much bigger time frame. So if you look at it from a monthly perspective, the dollar index is sitting within a range. Sitting within a range, which is more or less like this, sitting within a range. It's coming down to the bottom of the range and coming down to the bottom of the range. And until it actually breaks out of the range, we still have to consider it range bound. This is very important for your technical skills as a trader. Until we break out of a range, we're still in the range. So we can't assume that it's dropping aggressively now. That definitely means it's going to come out of the range. It could recover, slow down, and then turn around. So we could see a turnaround. We also know that it's overextended. So if we have a look at this, we can see that it's overextended by just the big moves down, especially if we go to the daily. We could see that we had a bit of a consolidation and a breakout. We're now sitting down towards the bottom, and we could potentially have a bit of a correction. So the reason I have drawn this trend line in here is just as a general guide, okay, just as a general guide, because should we come up and break it, then we're likely to have a deeper retracement, then we're likely to see the weekly come up, and so we could see it work its way back into these highs. Okay, so that's something to keep in mind. Now, the pound is stronger. How do we know this? Well, because if you just look at the pound, you can see how much more aggressive it is than when we compare it to the euro. The euro has moved up, but it's had a few down days in the move up, whereas sterling has just literally just been bullish day after bullish day after bullish day. Okay, so what does this tell me? This tells me that we have a weak dollar and a strong and that means that all the other currencies are doing really well. We have a strong trend in place. It tells me that there are money-making opportunities on these charts. Whether you trade euro dollar or maybe Kiwi dollar or dollar Swissy, for example, it's telling me that there are money-making opportunities on these charts. I don't have to trade all of them. Remember, the goal here is to take good trades, not just every trade. But it also tells me that we're overextended to the upside. We can see that the move we've currently experienced is bigger than what we've had in the past. Could it be significant? Could it keep going? It could. The odds of a correction after a really big move, especially when you compare it to the last couple of years, the odds of a correction in the near future are greater than the odds of it continuing, but both possibilities exist. In addition to that, once we look at the dollar index, we can see that it's within a range. We can see it's coming up to a key level. Now we know it's overextended. And when it's overextended and it goes towards a key level, it becomes tired. It's like, imagine you have an army that's invading a country that's heading towards a castle. And the castle is that strong resistance level. The castle walls are that strong resistance level. So usually what you wouldn't want to do is you wouldn't want to have your army marching every day for 2 weeks. And then the second they arrive at the castle, they have to now battle. They'll be very tired. They've been traveling for a long time. They'll need to rest before they can successfully break through the wall. So normally what would happen is if it's overextended, it's tired, it's had a lot of energy to move. This is a bigger than average move. Therefore, it's more energy expended. Therefore, when it arrives at that key level, there is a very high probability that it will have a correction to take a break before taking another attack at that level, for example. So what does that mean for us? Well, it means that if you're using the daily wave rider, these are the kind of charts where you're going to be looking for opportunities. So if you go look at euro dollar, you've got the right conditions. You've got the green pivot levels, you've got the 20 kind of in the right place, you've got the green channel, so you've got green lights there, but you don't have an entry, so you need an entry, and that entry could find that I'm just going to change the color of this so that you can see it, means that we could, I'll make it darker, could see price coming back to these highs. And if we did do that, where would that be as a Fibonacci retracement? Somewhere around the 618. It's perfect. So it kind of, I'm not saying we're going to turn around here yet, but just generally, it gives us a good idea as to where we could potentially see price coming back or back to the pivot over here. We could see that. And so it means that it should, all of these should probably sit on our watch list. Okay, so Aussie dollar isn't there, but it will potentially change. As price does, we'll see the channel turn around and then possibly see that go green. Kiwi dollar, definitely not. Cable, we will. So for those of you who trade my style of trading, if you trade the Spartan style, you'll be looking at Aussie and Kiwi as well. For those of you following the Wave Rider, which is a phenomenal system, it is the best indicator system I've ever seen. Okay, to be very clear, it is the best indicator strategy that I've ever seen across hundreds of courses probably. So it's the best one for beginners, and if you're new to trading, then just stick with the rules of the Wave Rider. Do not deviate from them. Dollar Swissy will probably sit on that list as well. We've got dollar CAD. Dollar CAD is giving you mixed signals. Let's look at dollar Sing. Dollar Sing will give you the correct signals. You'll be looking to sell. Dollar Yen, you'll be looking to sell. Potentially, when you come back up, you'll get a sell signal. Okay, so next up. So the majors are going to be on your list. Should we short using your own funds? I think the answer to that question is, if you feel that you are ready to be trading using your own funds, I would still recommend actually going with the Wave Rider strategy. I think it's the safest. The performance is generally very, very good. And again, obviously make sure that if it's your own money, you're making sure that you don't deviate from the risk parameters, use the same rules, make sure that that you apply the same guidelines and rules, okay? And if it ticks the boxes, you should consider it. Now, okay, cool, just checking the questions. So now what we're going to do is now we're going to look at it's almost like a Rubik's Cube. You want to look at all the euro pairs, all the pound pairs, all the Aussie pairs. What we've done here is we've looked at all the dollar pairs. Or do that for now. So one of the biggest tips that I can give newer traders let's talk about the things that when you hear about other traders failing, there are so many avoidable reasons why they do. The first one is that they don't stick to one strategy. They're all over the place. They see one strategy on YouTube, they have a strategy from their course, they see all these different things, they chop and change. And while they're doing that, on top of that, they move their stop loss, they change their risk, they take a punt. A punt is an English expression. They take a gamble, they mix it up. So it's a mixed bag with no real consistency. One person saying go long, the other person saying go short, and they get different results. And so in order to just, one reason to just be not one of those people that fails is to just stick to your one strategy. And I'm being honest here when I say, and genuine, like heart to heart, when I tell you that the Wave Rider is an amazing strategy. I have, years ago, one of the first strategies I learned was similar, but not as good. It had similar types of stuff, but it didn't have some of the filters that you have with the Wave Rider that actually are producing better filters, like you're getting better setups. It's very good at detecting early changes in trends. It's incredible. So I'm being genuine when I say to you that you should really follow the Wave Rider over almost any other strategy you have, unless you know for a fact that the other strategies are better. And I'm being serious about that. So especially when you don't have the experience. So how do we get experience as traders? Because to become a great trader, you need trades under your belt. You have to take trades. There's no way for you to become an experienced trader without having 1,000 trades under your belt. You can't do that because you learn so much from your losing trades. You actually learn more from your losing trades from your mistakes than you do from your wins. Your successes, you don't know if it was you at first or whether you did something right or whether it was the strategy, but definitely your losses can often be stuff that we can ultimately learn to avoid. So that's why I say that my Spartan guys will have a little bit of extra information that they have, but that's more advanced. And again, all the other traders that you get access to, but the Wave Rider is one of the, you could do that for the rest of your life and you'll be fine. So you could just do Wave Rider for the rest of your career and you'll be fine. You'll make plenty of money. And I mean that, you'll make enough money. So you don't need to go ahead. And so just remember that. Don't get caught up in the excitement of learning all these different strategies. The Wave Rider is one of the best ones, which means that I doubt there's another strategy out there that's going to make you double what the Wave Rider is going to make you. I doubt that. I doubt that, for reals. So I want you to have a bit of patience to do 100 trades with the Wave Rider. 100 trades with the Wave Rider. What I'm doing today, right now, is I'm giving you technical analysis experience by showing you charts without the Wave Rider, and then I'm showing you what the Wave Rider is telling you as well. So you're learning both. Okay, it's a bit of wax on, wax off. You know the Karate Kid reference. So now we're going to look at all the yen pairs. We're looking to see if there's a common trend within the yen pairs. Okay, so the first thing I'm going to do is go to a chart where there's no Wave Rider stuff on it and just look at it. So first we'll look at dollar yen. So here's dollar yen on the daily. It's had a big move down, it's had a correction. And this is one of those rare situations for the most part where fundamentals aren't, I don't worry about the fundamentals too much. The most important fundamentals are elections. Elections almost always happen near a weekend. And so you want to be very careful about having any trades open on any of those pairs over that weekend, because you could have a big gap up and a big gap down. The most important one, if no one has told you, is going to be the US election. This year, it's the most important one in the world in our lifetimes. It is Tuesday the 5th of November. So that'll be during the week. You don't want to be exposed on any dollar pairs at that time. And probably just for a couple of days, you want to reduce your risk by half. So if you were risking 1% a trade, go down to about 0.5% per trade. And just understand that there could be some volatility. There could be. I'm not saying there will be, I'm saying that there could be. If there isn't, that's a really good sign. Okay. So just to prepare you for that. So the reason I want to talk about dollar yen here is that Bank of Japan has been talking for ages about how they don't want dollar yen above 150. So there's very few countries that worry about this stuff too much, but Japan's economy is very much tied to the US. That's it's their biggest trade partner. And they tie it very much to that. So 150 for them was the upper limit. They didn't want it to go much further than that. And they have a lot of all central banks around the world have different tools they can tweak. policies and different levers that they could pull that will change things. They've obviously tried to bring it back below 150, and they're going to want to keep it there. And they always win in the end. So whether they win now or whether the price goes back up above 150 and they have to do a few more things, eventually it's going to come down below 150. They will win. Whether it's, there's a stranger walking up to my front door, I don't know, but they will win. So just be very cautious with that. But what does that mean? It means that it implies that, to me, the trend to the downside, whether it stays that way now or whether it happens in the next few months, is likely to be the case until they get it back with where they want it. And back where do they want it? Probably somewhere into about this area. They're probably going to want it back in there. Okay, so I think that there's a lot of pressure for it to move to the downside. Next up, we'll go look at the different yen pairs, and then I'm going to have a look at your questions. Let's have a look at this. Dollar Sing and cable were DW3, 3 stars on Friday, but an extreme end of each channel. Absolutely, completely agree. So I didn't take unless I had wanted to bet US dollar with what, yeah, Jackson Hole, absolutely. What's my recommendation for such future occurrences is to do what you did, is to not do it. It was overextended. And actually the problem with overextension, guys, so let me talk to you about this. And again, this is all extra stuff that you don't pay for, but you get anyway, is that you see a move and a pullback and a move and a pullback. And then you see the price goes this far. So now the distance is the same as the previous moves. And so actually at this point, it's very fair and normal for every trader in the world, experienced or new, to say, you know what, now it's overextended. I probably shouldn't get in now. And then it keeps going, and it keeps going, and it keeps going, and it keeps going, and it keeps going. So what happens is you go, oh, well, if I had got in, I'm not saying you guys, I'm saying that some traders will think, well, if I had got in, I would have made money. But here's the best answer to that for future occurrences. I love the way that you phrase that. Going forwards, what should I do? The thing is that extended moves like this are very rare and impossible to predict. And also the risk is higher. So once you get to a point that's roughly the same distance that you've had in previous moves, most professional traders, unless they have some amazing superpower that tells them, will just not engage. Or if they do engage, they'll reduce their risk and take profit sooner, because once it starts overextending, it could have gone here and turned around. It could have gone here and turned around, but it just went all the way up to here. And that's really unusual. It's a bigger than average move, and it's impossible to predict, and it becomes almost impossible unless you were already in the trade and you were trailing your stop loss. That is the only situation in which you would have benefited from it, but you still wouldn't have known that it was going to be such a big move. So the answer to your question, which is a great one, is yes, you did the right thing. In future, if there is a possibility, a real possibility of the market being uncertain, and it's already overextended, in other words, the conditions are already a bit like sketchy, you just sit it out. You'll very rarely regret that. You might regret it once or twice, but once you've seen it happen about 10 or 20 times, probably more often you'll see it go the wrong way, and therefore you'll be glad you stayed out. So very good. Okay. So true what you said about 1,000 trades anyway. So for both currencies, when it's overextended, what should I do on the following trading day? Stay out. If you do day trading, then you might consider shorter term trades. But the reality is now, if it's overextended, it is due for a correction. And the problem is you don't really know when it's going to happen. Well, that's not strictly speaking true. You'll start to see the divergence occurring on the 1 hour and the 4 hour, but only if you have been trained how to see that. So if you aren't there yet, if you're brand new and you're in your first 10 or 20 trades, it's better for you to just always be cautious. Be patient about doing fewer trades initially, but as your experience improves, once you start to be able to analyze, you don't even have to trade the 1 hour. You can just do technical analysis on it. What I'm referring to here is convergence and divergence. So if you're not familiar with that, which one day you will be, I want you to look it up. And also, when we talk about stuff like this and you go on YouTube and you watch a few videos, you shouldn't just watch one video. You should watch 10 videos on convergence, divergence to really understand it, okay? To really understand what it is. The most important part of that is divergence, not convergence, it's divergence. Divergence is when your indicator, whether it's MACD or RSI or Williams percent or whatever, is starting to deviate from price. So price is going up, but your indicator has started to go down, and there's a divergence between the two. That is an indication that the trend is getting weaker. That's all it is. Just an indication that the trend is getting weaker, and therefore we should maybe not take another trade. Maybe not. That's all it is. It doesn't mean you should now take a trade in the opposite direction. Hell no, doesn't mean that, okay? All right, let me go through these and I'll go back to the questions. So, do we see a pattern with the dollar pairs? Okay, this looks almost the same as dollar yen. There's dollar yen, there's euro yen, there's pound yen, Aussie yen, Kiwi yen. I think you can see where I'm going with this. CAD yen, Swissy yen, Sing yen. They're siblings of each other. So that in this case, what can we determine from that? We can determine that it is the yen out of those pairs that is the bigger driver of those moves. That's the first thing we can determine. So it means that yes, there is on the one hand, it's a double-edged sword. On the one hand, there is a greater probability of, if we just know which way the yen is likely to go, we have a higher probability of making money. The other edge of the sword is that if we take trades on all of them and we have too much invested in too many yen trades and there's a move in the yen against us, we lose more. So what you have to do in those situations, excuse me, is you can take 2 or 3 or 4 trades, but don't risk your full amount on each one. Just don't do it. Cut it in half or cut it down to a third. So what I would do, let's say that I see 4 yen trades that I really like. I like it because if the yen is bullish or bearish, it's a high probability that it's a strong move. Because we're seeing it across, it's moving every other currency out the way, which means it's a very strong move. And I see 4 trade setups. I won't risk 1% on each one, that's 4%. I will risk maybe 1.5 or 2%. That's me. So I'm not risking the full amounts, but I'm risking more than maybe 1% across all of them. And that means that some will go 2 to 1, some will go 3 to 1, maybe one will go more than that, maybe one will stop out. That happens. Okay, so all the yen pairs are looking to me more bearish than bullish at this time. Then let's have a look at all the euro pairs. So now I'm going to go euro dollar, looks bullish, it's trending up. So what are the rules, guys? These are the rules. This is more, I'm just going to put this in the group so everybody has it. Okay, just general criteria. First thing is, which way is the trend? Is it trending up? So, is it trending up? Yes, we definitely have an uptrend. Which part of the cycle is it up? Extension, retracement, extension, retracement, extension. It's clearly in the extension phase. Extension phase. So we can't get in on that. We must always get in on the retracement, okay, always. That, again, when you hear about traders losing money, that's one of the things they always break those rules. Given me an idea here, I need to write this down. I'm going to write an article about 10 things losing traders always do. Give me a second here. Just do this, quickly write it down. I'm just going to say 10 things losing traders always do. Trade extension instead of retracement. It's fine. Just a quick note to me. It's fine. There we go. Let's go back. Okay. So we're waiting on that. So that's euro dollar is going up. Euro yen is going down. Euro Aussie is going down. Actually, it's a downtrend. Euro CAD is going up. Euro Swissy is going down. Euro GBP is actually no clear trend. Let me show you why. Here was a downtrend. Then it came up and broke this high. So this downtrend is finished. Okay, because that's how it works. Uptrend, breaks it, no more uptrend. What's next? Which way is it going to go? I don't know. Lower high, breaks the low, downtrend. So in this very weird little moment between there and there, you don't know what it's going to do. It could have done this, back into an uptrend, breaking the high. There's your uptrend again. So it's broken the downtrend, but now it's here. This is a very, I don't really want to call it a downtrend, but it's a big correction. So big move up, big correction there. This is very straight up. So let's say no trend or maybe a downtrend, but it's not giving very clear options. We'd stay out of it. Euro Kiwi, downtrend, lower highs, lower lows. Euro Sing, uptrend, high lows, high highs. So what do we see? Uptrend, downtrend, no trend, all over the place. So what does that tell me about the euro? The euro right now is actually just being pushed around by whoever else it is trading against. Whoever the other currency is, it's getting pushed around. Okay, so euro is not as high on my list. Not saying there won't be a good wave rider setup on that, but I would go for the ones with very clear trends. I'm just saying to you that the euro itself, no clear trend. Let's look at cable. So there's cable very strong there. Let's look at pound yen going down. Let's look at pound Aussie. No clear trend. It was lower highs, lower lows. It's broken that, so no clear trend. Pound Aussie. Pound CAD will be going up. So pound CAD is trending up. Pound Swissy is giving some mixed signals. Pound Kiwi is giving no clear signals. So cable, GBP, is also not clear on what it wants. So I'll come back to the checklist in a moment. So let's look at the Aussie pairs. We've looked at yen pairs, dollar pairs, euro pairs, GBP pairs. Let's look at Aussie pairs. So Aussie here, uptrend. Aussie CAD, uptrend-ish, more bullish than bearish. Aussie Swissy, mixed signals here. I want you to keep, we're going to talk about the Swissy pairs. I want you to higher time frame analysis. We'll talk about that. Aussie Kiwi not really offering a lot. Aussie Sing, actually almost more bullish than bearish. Excuse me. Let's do the same for Kiwi CAD quickly. Kiwi CAD definitely bullish. Kiwi Swissy definitely bullish. Definitely bullish. I think it's broken that high. Okay, so I think Kiwi pairs are looking bullish. I'm going to write this in. I'll write this into the checklist. So USD weak, but due for retracement. Euro mixed. GBP mixed. AUD mixed. JPY, I'm talking about the JPY pairs. JPY pairs are generally bearish, okay? Bearish, I'm going to say bearish. And then we have CAD pairs. We're going to have a look at CAD pairs in a moment, and Swissy pairs. So let's go through CAD pairs quickly. So we can see dollar CAD is going down. But now we're going to go look at Aussie CAD. What's that doing? Aussie CAD is trying to go up. Euro CAD is heading higher. Pound CAD is heading higher. Kiwi CAD is going higher. So we have a lot of CAD crosses. So dollar CAD is going down. Why is dollar CAD going down? Because the dollar is weak. Why are the rest going up? Because when we look at the rest of them, the Canadian dollar is generally weaker against them. But it's not weaker than the US dollar. It's weaker against the other pairs. That's how weak the US dollar is. Okay, so we see that. So CAD pairs for me are looking good. So I should put them like this. Dollar CAD looking bullish. Dollar CAD pairs, dollar CAD charts. Which means if we look at them on Wave Rider, we should see some potential, maybe some potential opportunities. Maybe the markets haven't got there yet. So let's look at Kiwi CAD. So Kiwi CAD is looking bullish here, but the channel hasn't turned around. So you're getting some mixed signals there. So obviously don't trade them then. Pound CAD is looking good. Pound CAD looks good. Okay, let's look at the last one here, which is Swissy pairs. So we go back here, we look at Swissy pairs. And this is a special one. We talk about higher time frame correlation. So the daily, the weekly, every time frame has extension, retracement, extension, retracement. So it's like fractals, patterns within patterns. And you need to, ideally, you will have more winning trades if your daily and weekly are bullish, and you're buying, or you're selling and your daily and your weekly are bearish. More winning trades. But they go in and out of sync all the time. They're like planets orbiting and all kinds of things. They can be in sync and out of sync. So dollar Swissy here is going down. But what I want to do is I want to go to the weekly. So the reason this is it's a losing trade, but it's already been marked as a losing trade. I'm demonstrating a point here. This is for my Spartan guys. This is a losing trade because of all the Swissy pairs. So dollar Swissy is going to likely be a losing trade, but the other Swissy pairs are looking nice and bullish, and I want to show this to you. And the one you want to look at is the weekly time frame. So sometimes the weekly or monthly, just in case you trade the daily and you think, well, why do I care about the monthly or weekly? For us as humans, the time that we have to wait, the difference between a day and a week and a month is very long. But in the markets, it's more about price and price moves. You know, over a month, it could move 200 pips or something. And in a day, it can move 200 pips. So the price moves in a month and a week mean that actually looking at the monthly and weekly are worth your while just to have a look at. It doesn't mean you have to trade them, but they tell us more about key levels. They tell us more about trends. And they tell us a lot. So the Swissy pairs are telling us something interesting. Not the dollar Swissy. Why not the dollar Swissy? Because the dollar is so weak. The dollar is breaking all the other pairs. But let's have a look at pound Swissy, for example. So pound Swissy here is kind of stuck within a range. It's in a downtrend, but it had a very strong reaction off the lows here. So pound Swissy is looking interesting to me. There's not too much going on that I could tell you about at this time. Let's look at euro Swissy. Euro Swissy is interesting to me. Why is it interesting? Because we have what's called divergence. Remember I spoke about divergence earlier? So divergence means that the MACD is trending higher. So the MACD is bullish, and yet price is producing lower lows. So remember how I said to you that that means that if you get that disagreement between the indicator and price, that means that the trend, the price, could be losing steam. So in this particular case, it's going the other way, it's going down. But price was going down very aggressively, and then slightly less aggressively, and then it tried again, and it's now starting to produce more and more bullish signals are starting to come in. This is a more experienced sign that maybe buyers are starting to come in here, and that maybe we will be turning around and going into an uptrend, but it's on the weekly. If this was on the 5-minute chart, we could just watch and see it happen, or on the 1-minute chart, but this is on the weekly chart, which means this is stuff that's going to go on until well into next year. But I'm showing you this in the early stages. Okay, so we've got this bullish divergence and we've got bullish price action. So bullish divergence, we've got what appears to be a possible key level of support resistance right there. Price came down, bounced, came down again, bounced. Bullish price action, bearish lows, bullish divergence. We could see price turn around, and we'll know for sure when we see a break here. When it breaks above that level, we'll then be turning around. So it's a very slow turnaround. But look here, price was below the 50 here. So price over here is below the 50 here. It tried to go above, stayed below it, tried to go a little bit above it. It's still below it here, and then it's above it. Now we'll see if it goes back up above it. So it's a very slow, you're watching something that's going to take months to turn around. But that's Euro Swissy. Then we look at Aussie Swissy. Aussie Swissy also produced a very bullish signal here with very clear bullish divergence. Are you guys finding this useful, by the way? Should I just wrap up? Or do you want me to keep going? Okay, so what does this mean? It means that we could see price starting to turn around. Okay. Cool. I love technical analysis, I promise you. I went back and I paid a lot of money to do all these different courses, fundamental analysis, technical analysis. The very first one I did was in, I'm showing my age here, I'm 49 now, but when I was in my 20s, 26 I think, I bought this book and it was like trading the stock market because Forex market wasn't even really available to the public, maybe not. And I looked through it and it's got both technical and fundamental analysis. And I love this stuff, guys, and it is doable. This is a learnable skill, but it's like learning a language or a musical instrument. It requires practice, and if there's one tip that I can give you, trading success comes from doing the simple things really well. The simple things. So if it's complicated, super complicated, it's probably not going to work. It's probably not sustainable. Okay, so it's doing simple things really well. Um, and I write, I'm a contributor for investing.com. So I write articles that go to Bloomberg and all these different places. And I deliver the same stuff that a lot of other people that I look at their credentials and I think, wow, they're much better qualified than. But then I see what they write and it's garbage because they're not real traders, they're not real investors. They write a lot of theory and they have a lot of economics and stuff like that. And I worship people like Buffett, Charlie Munger, Peter Lynch, Ray Dalio, Larry Williams, who's a technical trader. I like people who've definitely got a proven track record. My point is this, is that I can tell if someone is, excuse my language, I can tell if someone's bullshitting because their answers are usually too complex and too wishy-washy. They should be able to give you a very clear, certain answer about why certain things are happening. Okay, but technical trading is the best because it's telling you these are the orders that are actually going through to the market. So when you see an article and it says JP Morgan says that the gold is going to go to this level, that's not really usable information. Especially if you look at gold, and let's just say hypothetically, gold was bearish, gold is downtrending on the weekly and the monthly, then that article is extra junk because if you have to choose between what you're hearing and what you're seeing on the charts, you always go with what you're seeing on the charts. Always do it. And you'll find that you'll always be on the right side of stuff. Cool. Okay, so let's have a look at these. Which means Swissy is weak. Any fundamental reason? You see, that's the thing I don't actually know. But I'll tell you what, let me get my little assistant to do some work for me. No, so sometimes I know about it. So like I know about the dollar and I know about the yen, but I don't really follow the Swissy stuff at this time. Let's see. So no, and sometimes you don't find out the reason until later on. So you see the market doing stuff, and then you find out maybe that the central bank was buying or selling their currency internally. They didn't want to let anyone know because otherwise they wouldn't be able to offload their position or be able to gain their position. So they did it on the sly. So sometimes you're not going to know why the market is doing what it's doing until later on. So let's have a look here. The Swiss National Bank recently made a surprise move by cutting interest rates, which was a significant shift from its previous stance, but okay. They opted to reduce rates rather than intervening in the foreign exchange market. So there you go. That's it. So they're similar to Japan. They try to do their stuff. There we go. I'm glad you asked so that I could look it up. Okay, cool. Now, so we've looked at all the Swissy pairs. I like them, but I'm expecting them to go long, but cautiously. Kiwi Swiss is looking good. How will I know when I'm like right now, these are still in the early stages of an idea. My idea is that when I see bullish divergence and I see that thing, there's a good chance it's going to turn around. How will I know for sure when the Swissy pairs are very bullish and they should be on my watch list? Ladies and gentlemen, it's not going to be for a few weeks. It's not going to be for a while. But the key point will be probably when I start to see, when I start to see it breaking above levels like this. So when I see it break above here, it comes back above this, then pulls down, then I'm just going to go, then I'll go long because then the momentum will have shifted. Right now, the momentum is trying to shift and hasn't managed to shift. Once it does that though, that'll be a sign. So in other words, I'll be much more aggressive in my trading to the upside there with a much more confidence, much more assertiveness. But right now I'm watching it. Okay. And let's have a look at gold and oil and then we'll wrap up. We're 44 minutes in already, so I apologize. So crude oil. Crude oil is a tricky one. Let me explain why. When you look at it from a monthly perspective, is it overextended? Yes, it is. Undoubtedly. When you look at the last really big move we had and take that move and put it over here, we are potentially overextended. So if it was a 1-for-1 move, 2,600 is possibly where we think gold's going to go. It's overextended already, but it could match that. It might not. So let's say I do it from there to there, but then I'd have to do it from here, from this low, and it's there. Okay, so it's definitely overextended. And if not from there, then I'd have to do it from there. But this is actually the most recent low. So we've got this low and then this low, and that's it. So that's kind of where it would be. I'm not overcomplicating. I'm just saying you sometimes get an A, B, C, D move. That's all. And that would be your A, B, C, D would look like this. A to B, B to C, C to D. Here's my thing. That was useless. There. Okay. Anyway. So that's a possibility. I think it's overextended. However, and will it have a correction to come back down? Yes. Could it come back down as far as 2070? Yes. Could it come back down to 2000? Yes, it could. Any of those are valid. Any of these are valid if it does have that correction. That's possible. But then when you go to so in other words, I think it's overextended, but it could have a little bit more to go. We go to the weekly. The weekly doesn't look so bad. So here's the problem with my previous one. Here we had a consolidation. We had a beautiful consolidation. We've just had a breakout. So consolidation is a way for a market to have a rest, to have a breather. So on the weekly time frame, we've had a rest and it's just broken out, which means it does have some energy left. So it could make it up to there and that would be perfectly acceptable. And I think this is very important. The weekly has had a break. It's got that energy to go. Therefore, I think it's got some good extension. It's got some high probability of going to 2600. Nice round number. And then we should have a correction. And if we start a correction and it's a monthly correction, we could see a correction that could come down, back down to this level or back down to here. I think that's very realistic. And I say that because I've been around long enough that I was here when price, this is when I started my trading journey, somewhere around here. So I remember gold going to all-time highs and then crashing for 9 years before it came back up to all-time highs. So in other words, do I think the price can come down? It can always come down. If gold can have a massive correction, anything can. So it's bullish, but it's now entering dangerous territory. So when you look at it from this, I just want you to keep an eye on that. When you look at this, for example, when we go here, this is a beautiful break and a retest. Look at that. Break, retest, bullish candle, which means this is technically a buy signal. So if we go compare this, let's go look at this on Wave Rider. We've got a buy signal. So gold is a buy signal. I just want you to be aware that there is risk, and I think that we are approaching the end of a run, but the weekly kind of gives me a bit of confidence with that. The daily looks good. Oh, I appreciate it. Thank you, sweet. You're very sweet. Silver. Also looking weird, but when you go let's go back and look at silver. You've got a break and a retest as well. So arguably this is a buy signal. Again, for my Spartan guys, the reason it's called Spartan is because Spartan, when you hear the expression Spartan living, it means you live with very little. You live with your bare needs. So you just have like a chair and a table and a lamp and food. Like it's always very simple, plain living. That was the whole idea. So, but it's not just that, because Spartans were warriors, right? So the whole idea with me calling it Spartan was, but it was you were trading with price action and horizontal levels. You're trading with the purest stuff. And then of course I love that expression that the more you sweat in training, the less you bleed in battle, which applied to trading means that the more educated you are, the better you're going to fare. Paul was one of my original mentors when I first got started. So, and Chloe and I started at the same time. We started in the same building. We were all in the UK together. And Paul was very hard on me. He thought I was messing around way too much in the beginning, which was true. I was all over the place. I was a cowboy. I'm not that person anymore. And I'm lucky because I think that the people that keep you in line are the people that prevent you from maybe having bad experiences, that maybe make you, even if it's your own doing, that maybe make you not lose your love of trading, because it is a learnable skill. But again, the secret is keeping it simple, being consistent. And although that's exciting to change strategies, to do all the different things, you mature as a trader. The excitement for me comes from not making money on a trade, but managing a trade really well. Like I'm like, holy cow, I squeezed every bit of money that was to be made out of that trade. Or, you know what, I thought, had a bad feeling about this, I didn't take the trade. So that's where your excitement, you have to kind of rechannel it. That's where it comes from. It's kind of like, you can get bored. You can get bored. Once you get to a point where you are sort of consistently making money, you get lazy. Because it kind of, now you've worked so hard to get there, it gets easier. But you worked really hard to get there. You bled, you had losing trades, you were in pain. Then you get to a point where you don't have the pain anymore, you're not bleeding anymore. So now you're not as sharp, you're not as on edge, you're not ready to fight anymore because you're kind of fat and lazy. And actually the problem with that is that's its own problem. You lose interest, you get bored. It's like somebody says to you, I'm out of shape, I want you to get me in shape. So you give this person the perfect diet and workout plan. They turn into a world champion bodybuilder. But now that they've achieved the goal, they're like, okay, I'm done now. I don't want to do this anymore. I'm going to go do something else. I've achieved the goal. I know how to trade. I know how to make money if I want. And then they get bored and they do it. And you're amazed. People stop looking for trades. They just suddenly don't have the time during the day and stuff. I don't want you guys to do that. This is a real way to make money. You need to be dedicating as much time to your trading every day to look for trade setups, to take the trades, to manage the trades as you would towards exercising every day. One is your financial health. The other is your health. Okay, your physical health. And then you need your mental health and your family and all that stuff. So anyway, I'm chatting too much, but it's important. Then we've got crude oil. So I think there's something here. So although Wave Rider doesn't do it, my Spartan guys will look for a setup here. The Wave Rider is actually a very safe way because it makes sure that there's more stuff in your favor before you take the trade. That's why it has a really high success rate. When you start become more experienced, you look at more things, but then the pressure's more on you to be right than it is on the system. We haven't broken this downtrend yet. We're starting, like if you think of this as if you think of that as a trend, we haven't really broken it yet. So if I go like this, you won't really, the Wave Rider probably won't go bullish until you break through here. In other words, it's really looking for enough of a shift in momentum to go long. But gold's looking bullish. Excuse me, we're above the 50 period here. So you guys know me, above the 50, probably a little bit more bullish. Excuse me, we've broken this high. We've broken this high here. Oops, there, we've broken that one. We're sort of breaking there. We're more to the upside than we are to the downside. Then, we could potentially be looking at a possible opportunity here, but it's higher risk. So I'm not saying to you guys to take it. I'm saying watch silver, it looks nice and bullish. And then finishing off, ta-da, the S&P, all those things will look really good here. So I'm almost done. Sorry, 2 more minutes and I'll wrap this up. So we've got crude oil sitting on a level here. I think it's likely to bounce up. The problem we have is that we also have these things coming down. So I don't really know if I expect crude oil to keep going up. I want to be a bit cautious about that. We've got a definite series of lower highs. And what could be happening is we could be heading towards, believe it or not, a point in our future where crude oil breaks down. And if it does, where's it going to go to? Probably down, maybe down to about there. We could see a move down $54, but only if that pattern stays intact. So just be very cautious with buy moves here, because if once they hit that, they're going to probably stay below those. If they start to break above this high, so in other words, if crude oil broke above $83, whatever, then I'd be bullish. But I'd be very surprised if it broke and stayed above that level. Finally, let's have a look at the global indices. And so there's no clear direction here, because it's kind of up and down and up and down. It's mixing stuff up there. So let's look at the indices very quickly. What's the situation? We've had a pullback here when you look at it from a monthly. So very quickly, this is one of the most important points. A lot of people have an opinion on the stock markets about whether they should go up or down, or whether you should have a bear market or a bull market. Forget all about all that nonsense and just remember a couple of the following things. The indices are made up of the best performing companies in the world at all times. In amongst them, there'll be a few terrible ones that underperform, but the best performing ones will always lift up the rest. There's almost always more better performing ones than weaker performing ones. So they generally will lift it up, which means that the indices are always meant to be made up of the best survivors, the best performers under almost any circumstances, which means that they will tend to go up. If the indices are going down, then the whole market globally is definitely taking a hit. But they're meant to go up. So in other words, when the indices are going up, that actually makes sense because they're meant to be. Even in a bear market, you're going to get companies that do well. And today, things like companies that are looking at green energy, renewables, companies that look at waste management, how do we reduce the amount, clean things up and stuff, they're doing well, even in a recession. The big corporations who can survive, like the Costco's and the different companies, they can do okay during these periods, during recessions, because then people start spending more with them. So I want you to understand that generally speaking, the markets should actually be going up more often than they do anything else. It kind of makes sense, but definitely the US markets, because the US economy is the strongest in the world. So when I go to the UK, it is trending higher. It is trending higher. It is bullish. We are in a bull market. I'll explain that very quickly. It is bullish. The DAX is generally looking bullish. The EU is generally looking bullish. Aussie is also generally looking bullish. The Nikkei also had a big correction, but still more bullish than bearish. HK is turning around. Same reason as I told you guys earlier. Same reason here. HK is at a key level, but it's got very nice bullish divergence. It's trying to produce a series of higher lows. It's also similar to what I spoke about with the Swissy. And we've got China, which is the same as HK. It's exactly what I just told you about that. So the next thing you might be going is, yeah, but what if we have a bear market? So first of all, you need to know the stats. We have fewer and fewer bear markets today than we ever had. If you go back 100 years ago, you had a bear market about every 3 years. Now we have a bear market anywhere between 7 years and 15 years. And when you look at the S&P 500, which is the best one to use, why? Because it's made up of 500 companies. Okay, it's 500 companies that are all around the world, your Starbucks, your Nike, anything you can think, McDonald's, all around the world. Therefore, it's a lot of constituents, it's a lot of data, and they're global. So it's a really great example to use that. If you look at the history of that, okay, so if we minus out here, you can see here is where we had the 2009, 2007, 2009 global financial crisis. We didn't really have another crisis. This was an election year like we're going through now. So the market was a bit uncertain. Then the market sort of kicked off. Then it had the Trump period, which was very uncertain because the guy was completely unpredictable, which is a fact. Whether you like Trump, whether you don't like Trump, very unpredictable. The markets didn't really quite know what to do all over the place. Biden comes back in. Now, don't forget that Biden is, whether you like him or don't like him, Biden was the guy that helped do this. So Biden did this, he did this, then we had a bear market. So we had COVID here, then we had a bear market. So we've had a bear market here, then we get 2009, 2021, we get a bit of a correction, a big correction, a lot of steam gets let off. Then we have a bear market here, and this is where we are now. So what do I mean by that? I'm saying that if you take these two corrections and these two corrections and you combine them, and you look at this, we had a good run, we've had a couple of corrections and a nice market move. We're not due for a correction anytime soon. We really aren't. I would say the market is very warm. I would say it's very aggressive. The angle is going up steeper. So yes, in many ways, I would expect not a bear market, but maybe a correction, maybe more of a correction. So it's not quite a bear market, not as bad as that, but maybe a couple of corrections, or maybe it starts to go sideways a bit or lose its steam. That's all. That's all I'd be more expecting. But I'm just trying to say that we've had a bear market recently, just 18 months ago, year before last, and we've also had COVID. So the market's had a lot of corrections. It's kind of due for a little bit of growth. And actually the markets are looking pretty good. When you look at it from a weekly perspective, we had a really nice retracement recently. We should be looking good. So the only other concern to that is Septembers tend to be bearish. Historically, we tend to have bearish, if you look at these, that was September, August, August, September, October. This was September. And often we would have a bit of a correction on that. And looking here, that was September, and this was September. So usually Septembers are very red. That's the only thing. But it could be because we're in an election year, and therefore that's not going to happen. That's it. All right, guys. Let me check your questions. I want to wrap up here. Thank you very much. And let's wrap this up, guys. I want to wish you all the best. I hope you enjoyed this. As always, I'm sorry I ran over, but I always think it's really cool to cover these things and throw in an extra bit of information. We took an hour. I'm so sorry. I'll try and do it in 40 minutes next time. Okay, but thank you very much. I'm going to let you go, stop sharing, and I look forward to seeing you guys soon. Okay, thank you.